Group audits. Applicability of preparation of consolidated financial statements. Applicability as per Companies Act 2013, as per Section 129 of Companies Act 2013, where a company has one or more subsidiaries, including associate and joint venture, it shall, in addition to its own financial statements, prepare consolidated financial statements of the company and all subsidiaries. Provisions applicable to preparation and audit of financial statements of holding company shall mutatis mutandis apply to consolidated financial statements. Consolidated financial statements shall be made as per Schedule 3 and applicable accounting standards. Company which is not required to prepare CFS under accounting standard, it shall be sufficient if it complies with the provisions of CFS under Schedule 3. Non-applicability of CFS as per Companies Act. A requirement relating to preparation of CFS shall not apply if company meets following all the conditions. Three conditions need to be satisfied. First one, it is a wholly owned or partially owned subsidiary of another company and all its members have been intimated in writing that they do not object to company for not presenting CFS and its securities are not listed on any stock exchange in India or outside India. Not listed, not going to be listed also. And its ultimate or intermediate holding company files CFS with ROC. In all such cases, CFS is not required to be prepared by the company. Next, non-applicability on investment entity as per Ind AS. Investment entity. What is an investment entity? Investment entity is an entity that obtains funds from investors for providing them with investment management services. It commits to investors that its business purpose is to invest funds solely for returns on investment and measures and evaluates performance of all investments on fair value basis. Investment entity need not present CFS if it measures all its subsidiaries at fair value through P&L, that is FVTPL, as per Ind AS 110. However, parent of investment entity shall prepare CFS unless parent is also an investment entity. However, there is no exemption for temporary control or for operating under severe long-term funds transfer restrictions in Ind AS 110. Non-applicability as per AS accounting standards. As per AS 21, subsidiary should be excluded from CFS when control is intended to be temporary because shares are acquired and held for subsequent disposal in near future or subsidiary operates under severe long-term funds transfer restrictions. Next, responsibility of parent. Preparation and presentation of CFS is the responsibility of management of parent. This includes identifying components and financial information of components to be included in the CFS, identifying reportable segments for segmental reporting, identifying related parties and related party transactions for reporting, making appropriate consolidation adjustments, harmonization of accounting policies and accounting framework, gap conversion where applicable. What are the objectives of the auditor in audit of CFS? Auditor's objectives in audit of CFS are to satisfy himself that CFS is prepared as per applicable financial reporting framework, to enable himself to express an opinion on true and fair view presented by CFS, to inquire into matters specified in Section 143, subsection 1 of Companies Act 2013, to report on matters given in Section 143, subsection 3 of Companies Act 2013. Auditing the consolidated financial statements. First, planning audit of CFS. Before commencing audit of CFS, auditor should make plans for the following: understanding of group structure and group-wide controls, including assessment of IT system, understanding accounting policies, including translation process of financial statements of foreign components, determining nature, timing, extent of audit procedures to be performed based on assessment of risk of material misstatements, ROMM, determining extent of use of other auditors' work in audit, coordinating work to be performed, completeness of information regarding inclusion of components in CFS. Auditor should verify that all components have been included in CFS. In respect of the completeness of this information, he should perform following procedures: review his working papers for prior years for known components, review parents' procedures for identification of various components, making inquiries of the management to identify any new components, review investments of parent and components to determine holding in other entities, review joint ventures, joint arrangements, and statutory records maintained by the parent, identify changes in shareholding that have taken place during the reporting period. Next, permanent consolidation adjustments and current period consolidation adjustments. Under that first one, permanent consolidation adjustments. Permanent consolidation adjustments are the adjustments that are made only on first occasion or subsequently when there is a change in shareholding of the entity. These are determination of goodwill or capital reserve, determination of equity attributable to minority or non-controlling interest. How to verify permanent consolidation adjustment? Auditor shall verify the above calculations is made appropriately. Auditor shall pay particular attention to determination of pre-acquisition reserves, examine whether pre-acquisition reserves have been allocated appropriately, verify changes taken place in these permanent consolidation adjustments due to subsequent acquisition or disposal of shares in components. Next, current period consolidation adjustments. What is meant by current period consolidation adjustments? Current period consolidation adjustments are adjustments that are made in accounting period for which consolidation of financial statements is done. They primarily relate to elimination of intra-group transactions and balances, including intra-group interest paid and received, unrealized intra-group profit on assets transferred from or to other subsidiaries, intra-group indebtedness, adjustments for recognized subsequent events that occur between balance sheet date and date of auditor's report, adjustments relating to harmonizing different accounting policies followed by parent and components. In case of foreign component, adjustments to convert components financial statements from local gap to the gap under which CFS are prepared. Adjustments of deferred tax arising from elimination of intragroup profits and losses. How to verify current period consolidation adjustments? Auditor should review memorandum records to verify adjustment entries made in preparation of CFS. Apart from reviewing memorandum records, auditors shall verify that intragroup transactions and account balances have been eliminated, verify that CFS have been prepared using uniform accounting policies, verify adjustments made to harmonize different accounting policies, including adjustments to convert components financial statements from local GAAP to the GAAP under which CFS are prepared, verify adjustments relating to deferred tax arising from elimination of intragroup profit and loss, verify calculation of minorities or non-controlling interest. Next, other special considerations. Consideration regarding determination of materiality during audit of CFS. For determination of materiality during audit of CFS, principal auditor shall consider following. Principal auditor is required to compute materiality for group as a whole. The materiality should be used to assess appropriateness of consolidated adjustments made by the management. Principal auditor can also use materiality computed on group level to determine whether components financial statements are material to that group. Principal auditor also computes materiality for each component if it is required for true and fair view on CFS. Principal auditor also obtains certain confirmation from component auditor like independence, disclosure requirements, etc. While considering observations of component auditor like modifications, etc. in his report on standalone financial statements, principal auditor should comply with the requirements of SS 600. Therefore, concept of materiality would be considered while considering observations of component auditor. Disclosures need not require to be given in CFS. Only those disclosures should form part of notes of a CFS which are relevant at group level. Following are given in notes of separate financial statements of parent and subsidiary need not be included in CFS. Source from which bonus shares are issued. Disclosure of all unutilized monies out of the issue. Disclosure required under MSMED Act. Value of imports on CFS CAF basis. CIF basis in respect of raw materials, components, and capital goods, expenditure in foreign currency on royalty, professional fees, interest, and other matters, value of imported raw materials, spare parts, and components consumed, amount remitted in foreign currencies on account of dividends, earnings in foreign exchange, management representations regarding CFS. Auditor of CFS should obtain written representation from parents management on following matters: completeness of components included in CFS, identification of reportable segments for segment reporting, identification of related parties and related party transactions for reporting, appropriateness and completeness of permanent and consolidated current period consolidation adjustments, permanent consolidation adjustments and current period consolidation adjustments. Next, reporting. When parent's auditor is also auditor of all its components, auditor should report whether principles and procedures for preparation and presentation of CFS are laid down in accounting standards have been followed. In case of any departure or deviation, auditor should make adequate disclosure in audit report so that users of CFS are aware of such deviation. Auditor should issue an audit report expressing opinion whether CFS give a true and fair view of state of affairs of group as on balance sheet date. When parent's auditor is not the auditor of all its components, auditor of CFS should also consider the requirement of SS 600. As per SS 706, if auditor wants to make a reference to audit of other auditors, auditor's report on CFS should disclose clearly the magnitude of portion of financial statements audited by other auditors by including other matter paragraph in report. This may be done by stating aggregate rupee amounts or percentage of total assets, revenue, and cash flows of components, including in CFS not audited by parent's auditor. Such reference is not to be construed as a qualification of opinion, but rather an indication of divided responsibility between auditors of parent and its subsidiaries. When components auditors report on CF on financial statements under accounting framework different than parent, when components financial statements are prepared under different accounting framework, that is US GAAP or IFRS, parents management perform conversion of component audited financial statements from component framework to framework under which CFS are prepared. Conversion adjustments are required to be audited by principal auditor. Component may alternatively prepare financial statements on the basis of parents' accounting policies to facilitate preparation of CFS. Principal auditor should perform necessary procedures to determine compliance of policies with GAAP applicable to parents' financial statements. When component auditor reports under auditing framework different than parent, component financial statements should also be audited under framework that corresponds to auditing standards generally accepted in India. Components are not audited. Generally, financial statements of all components included in CFS should be audited. If financial statements of one or more components remain unaudited, auditor reporting under CFS on should consider unaudited components in evaluating possible modification to this to his report on CFS. So he should consider possible modification on report on CFS.